My name is Nicholas Aiello, and I will be analyzing a new potential investment opportunity with a portfolio based on reducing our carbon footprint. Our carbon footprint is increasing quickly and consistently. Since 1960, the amount of CO2 in our atmosphere has increased by nearly 33% as observed at the Mauna Loa Observatory. The annual mean growth rate per year has nearly tripled from what it was back in 1960, and it is trending in the wrong direction. Investments must be made by not only governments, but corporations and households as well in order to transition the world's economy to a low carbon path. According to Hortense Bio, the Director of Passive Strategies and Sustainability Research at Morningstar, climate has become the biggest theme in environmental, social, and corporate governance investing, or ESG. Bio claims that there are two different ways investors can adjust their portfolios with climate change in mind. One of those is by reducing risk. Bio suggests to analyze your surroundings and realize what is going on. Limit your exposure to companies that are less likely to do well in a world that is getting hotter. Some companies to consider avoiding are those that deal with oil and gas, or those that are heavily exposed to coal or other highly polluting industries. The other suggestion Bio had involving climate change is to consider it as an investment opportunity. Look for companies that will benefit from transitioning to a low carbon economy. If companies are actively trying to solve environmental issues, there could be growth potential. According to fund managers at Impax Asset Management, a company that specializes in investing during a transition into a more sustainable global economy, investors should take a look first to companies that fall under one of the four main sectors that are considered main culprits for large emissions. Those four sectors are energy, food, transport, and agriculture. In this portfolio, I suggested 5 different stocks, all in varying sectors. As previously mentioned, the 4 main culprits of our increased carbon footprint are energy, food, transport, and agriculture. According to Forbes, 3 of these 5 companies are listed within their list of 101 companies committed to reducing their carbon footprint, and they are all in a sector relating to those main culprits. Tesla, located in the transport and automotive sector, is known for its electric cars. Everything Tesla does is sustainable, from the cars it creates to the manufacturing processes to build them. Starbucks in the food sector, according to Forbes, is aiming to be free of plastic straws by 2020 by redesigning its cold drink cups with a strawless lid that is being rolled out in the US and Canada. John Deere in the agricultural sector aims to recycle 85% of materials and reduce carbon emissions on 90% of new products to create sustainable inventory. The next stock we want to use in this portfolio is Renewable Energy Group Incorporated, or REGI. According to a survey conducted during Dr. Laura Stark's 2020 FMA keynote speech, Climate Risk and Investors, investors perceived renewable energy to be the most likely opportunity resulting from a shift to a low-carbon economy. Renewable Energy Group is estimated to be one of the top investments for Q1 of 2021, as its price-to-earnings ratio is low at only 3.9 compared to other energy companies such as Canadian Solar or Jinko Solar Holding Company, with price-to-earnings ratios of 11.5 and 16.3 respectively. The final stock in this portfolio is DS Smith. DS Smith is a recycling and waste management company and is considered a top 10 holding according to Impax and should be able to round out the portfolio with its upside. These final 2 stocks are included not as companies taking extra steps to help lower the carbon footprint, but as companies that could see growth due to that climate change. This portfolio is put together with the behavioral theory in mind. The behavioral profile theory is different from the standard profile theory in a variety of ways. In behavioral profile theory, efficient portfolios are found on the behavioral wants frontier. Portfolios on that frontier also satisfy wants for utilitarian, expressive, and emotional benefits. In standard profile theories, investors view portfolios as a whole, but in behavioral theory, they view portfolios as pyramids that are layered with a want and a goal. They also measure risk differently. Behavioral theory measures it by the probability of shortfalls, whereas standard theory measures risks by the variance of returns. The final difference is that investors are always risk-averse in behavioral portfolio theory. For the proposed portfolio, we are aiming for upside potential on the behavioral wants frontier. When referencing upside potential on the layered pyramid, we took a close look at the utilitarian benefits, expressive benefits, and emotional benefits while selecting which stocks to include in our portfolio. In general, utilitarian benefits are enhanced as consumption and asset accumulation are enabled by riches. Basically, this means that people can spend more money to buy high-end material items and move up in social class. However, there is more of a risk involved with upside potential, as opposed to downside protection, where utilitarian benefits are constrained by poverty, which means that people are limited in their options due to financial woes. Those in the upper echelon of the pyramid are also financially independent and have financial freedom while maintaining a high level of social status, opposed to those in the lower echelon who have financial peace and security that comes with their downside protection. They're secure in their positioning and they don't have a fear of falling into poverty. With the proposed portfolio, we are aiming for more upside potential with higher end stocks such as Tesla and John Deere that are also well known and increase social status with the acquisition of some of those products. With these stocks, as well as Starbucks, Reggie, and DC Smith, we're also looking at the upside of how their environmental efforts will affect their stocks in the long run. However, after compiling data, we are also remaining true to behavioral theory, as the portfolio includes low risk and risk averse options. Based on a variety of factors, this is how we believe the asset allocation should be split up. Invest 30% of our allocated funds into Starbucks, 25% into John Deere, 20% into Renewable Energy Group Inc., 15% to Tesla, and 10% to DS Smith. In order to come to this conclusion, we use stock price, level of risk, stock beta, standard deviation, upside potential, potential climate impact, and recent trends to influence the final distribution. We believe the group most suited for our portfolios would be environmentally conscious, upper middle class to wealthy social class, interested in environmentally friendly companies, socially responsible, and interested in both downside protection and upside potential. Figure 1 displays that environmental concern is pretty balanced across ethnicities, and some minorities, such as Latinos, Asians, and Blacks, are publicly perceived to be less environmentally conscious. However, research found that public perception is often wrong, which is why our target demographic absolutely includes these groups. We also wanted to include those seeking downside protection in addition to those seeking upside potential in our target demographic, because while our portfolio is more built towards those seeking upside potential, the stocks included in it are low risk. Our research also shows that oftentimes poor people are more environmentally concerned than wealthy people, so to leave them out of our target demographic would be a missed opportunity. The data gathered for stocks in the portfolio begins with a current stock price as well as a 5-year history of each stock. As evidenced by the graphs, these stocks all have one thing in common: they're trending in the correct direction. All of these stocks have increased in price within the past 6 months and significantly over the course of the past 5 years. They are also relatively affordable outside of Tesla and John Deere, which are highly priced. These stocks are the main 2 stocks which push the portfolio into upside potential layer of the behavioral pyramid. DS Smith is a high upside, virtual no risk choice for this portfolio, as its profits will come from the economy going more low carbon, but the current price is affordable for all at only $4.53 per share. Starbucks and Reggie are 2 stocks that have both consistently climbed, and with how important renewable energy will be in the fight against climate change, Starbucks' commitment to decreasing their own carbon footprint, these are 2 good options that won't break the bank, with upside to round out the portfolio. Our determined allocation numbers came from reviewing the 5-year history of each stock in our portfolio. We got the monthly standard deviation for stock prices for all 5 of our companies, and they each reflect the beta for those stocks. The beta of a stock measures the stock's volatility against the entire market. By definition, the S&P 500's beta is 1.0, and individual stocks are given values based on how much they deviate from the market. A beta value under 1 suggests a stock has less risk but also offers lower returns, while a beta value over 1 means that a stock has greater risk but offers higher returns. Research shows that Tesla is far and away the most volatile of the portfolio, but with their environmental friendliness and in the form of electric cars and moving away from oil and gas, Tesla should continue to be on the rise in the near future. Meanwhile, Starbucks is the least volatile of the portfolio and should offer steady, albeit lower returns in exchange for consistency. These beta values align nicely with the research gathered, on standard deviation as they each demonstrate a correlation between stock and level of volatility. In order to get the standard deviation of each stock, we simply gathered the monthly historical data on each stock for the last 5 years and measured the difference of closing prices from month to month. The lower the standard deviation, the more consistent the stock price was, which reflects the beta values nicely. Behavioral profile theory is predicated on risk and risk management. Investors are always considered risk averse and would rather play it safe than losing big. With risk playing such an impact on an investor's willingness to select a portfolio, before anybody capitalizes on our opportunity, they must understand the risks and how our portfolio manages them. Some things to consider are a company's sensitivity to resource risk, what a company is doing to reduce their footprint, and how those actions will help them move forward. In each stock that was presented as part of the portfolio, it has been established that the companies aren't at risk of losing resources as we are planning to move towards a low-carbon economy. It also has been established that each company has taken up new initiatives to help lower their own carbon footprint, such as getting rid of plastic straws completely or recycling up to 85% of the materials. These actions will not only reduce their carbon footprint, but help cost efficiency in the long run as well. Companies must also take into consideration how climate change and high carbon footprint will affect regulatory risk, which includes changes in regulation, physical risk, which is in changes in climate, and technological risk, which is climate-related technological disruption. With the stock selected, they shouldn't run into any problems with any of these risks. In summary, this behavioral theory portfolio takes into account a variety of different data points to select the best stocks for building a better future. Each company was carefully researched and handpicked in order to ensure that they would do their part to move the world forward. With climate change and carbon footprint as a central focus, we feel that we offer the best possible allocation of the stocks in order to maximize profits and minimize risk. Thank you for viewing my presentation.